In this example, we are looking at determining cash flows from financing activities, specifically with notes payable. All transactions involving notes payable and related accounts of Diamond Company during 2014 are as follows. So you can see, let's just kind of talk about these journal entries right now. In the first journal entry, we received cash and we issued a note payable. So what that means is we went to a bank or a financial institution, we got a loan, and in turn they gave us cash. Then in the next transaction, we purchased a patent, but we didn't purchase it with cash. We went to the bank and got a loan to purchase that patent. So this transaction, the second one there's no actual cash involved, but it's still a significant transaction because what's happened is we've purchased an asset, which is an investment, but we paid for it with a notes payable, which is financing activities. So you're still going to see that, but it's going to be on the schedule of non-financing and investing activities. Then in the third journal entry, we're debiting our notes payable, so we're decreasing it. That means we're paying $500 to the notes payable, but we're crediting cash for $5,500. The cash, the $5,500 in cash is the important piece, but we also have to keep in mind that we're splitting up that $5,500 because interest expense belongs in the operating section, whereas notes payable belongs in the financing section. So let's take a look at how we would construct the cash flows from financing activities. So the first thing, we issued a note payable. So as I mentioned, we received cash for that note payable. So that's considered a cash inflow, which is why you see the $18,000 shown as a positive number. Then we repaid a note. We paid $5,000 that pertained to that note. Granted, we paid $5,500, but the portion, the principal amount for the note was actually only $5,000. And since we repaid it, that means we spent money, so that's in parentheses to show a cash out. Then on the schedule of non-cash investing and financing transactions, this is the second journal entry above. We are trading one for the other. So we're using a financing activity to purchase an investing activity. So since there's not cash involved, it's not going to fall in any of the three categories, but it is going to be in the section at the bottom of the statement of cash flows that represents the schedule of non-cash investing and financing transactions. So there it says we issued a note payable for patent for $30,000. And then as I mentioned, that $500 in interest would be included in the operating activity section, which is why you don't see it in the financing section.